So it's time to dive deeper into liquidity by a deeper understanding of what order blocks is, or supply and demand zones. So let's take a look at it, and let's start by recapping what is an order block. Well, as we know by now, if market pushes up from a certain level, you have a lot of buyers stepping in, and market is pushing up, buyers all the way up, until market reaches a certain level. At that level, like let's say here, for example, this is the previous high of the swing. So of course, a lot of these buyers will want to cash out here and cash in the profits because they fear this resistance level here. So when they're cashing out, they create a lot of sell orders. There's a lot of sell orders here now, and most often there will be more sellers than buyers because all of these buyers wants to sell. So what happens is market pushes down now, but all these sell orders doesn't fill. So you still have a whole block of sell orders laying here, and that is an order block. Let's look at different types of order blocks and what they do. Let's start with a wick-based order block. Most often the order block is the last bullish candle before the bearish sequence starts, or the opposite, the last bearish candle before the bullish sequence starts. In this case here, what do we have? We have a candle here, the last candle before the sequence, the bearish sequence starts, and this candle has big wicks, and especially the top wick is greater than half of the whole candle. If the top wick is greater than half the size of the whole candle, then you count the top wick as the order block. So as you see here, this blue zone representing the order block is exactly the size of the top wick. That's a wick-based order block, and as you see, respected perfectly. Now let's look at an impulse order block. What is an impulse order block? An impulse order block is when the last bullish candle before market turn bearish is great, is big, and is much bigger than the bearish candle coming after it. In those cases, what you do is you count the last bearish candle as the order block instead of the last bullish candle. So you count the last bearish candle before the big push candle, which is this one here, that pushes the market below this bullish candle. So as you see here, this candle engulfs this last bullish candle, and therefore the candle before this engulfing candle is the order block. That's an impulse order block. A mid-movement pivot order block is basically when you see the market push down, it does a little hiccup, and then it proceeds to push down. That little hiccup is most likely going to contain a candle in the opposite direction. So in this case here, a bullish candle. That bullish candle is the order block. And what happens is when market comes back, you see it respects it very well and rejects it because it picks up the liquidity from there and continues down. Then we have the engulfed order block, which is one of the most popular order blocks, I would say. An engulfed order block is basically the last candle. In this case here is a bearish candle before a bullish sequence. And you want to see this last candle being engulfed before the sequence candle. So this bullish candle fully engulfs this last bearish candle, and therefore this is an engulfed order block. Now we have something called breaker order block. These ones are important because these ones tend to confuse people. What is a breaker order block? So you have an order block here, and market does its thing. When it comes to the order block, what does it do? It shoots straight through. Why? Because this order block, instead of rejecting the market, it actually accelerates the momentum of the market. So market pushes straight through, hits this wick-based order block over here, respects it perfectly, and then starts to push down. And what happens? It comes back to the level of this order block here, and it respects it perfectly, accumulates and pushes up, creates a new order block here before it decides to push down again and pushes through this order block. That's a breaker order block. So whenever you see situations like this where market has pushed straight through, rest assured that when the market turns and comes back down, it's going to face a hard time push through this order block again. Most likely it will reject this order block and push up like it did here. That's the different types of order block. Now let's look at what qualifies as a high value order block, as what we call it extreme order block. So here we have an extreme order block, and I will explain why it is extreme. Well, what is our criteria? First and foremost, order block must leave inefficiency behind. As you see this order block here, this is the order block. What has it done? It has left inefficiency behind. Fair value gap here, right here. Number two, the order block must break something. So it means the sequence after the order block must break something, break structure or change of character, as you see here. Number 3, price must sweep a liquidity zone before reaching the order block. What did the market do here? Liquidity, stop losses, right? And this wick contains a lot of these stop losses. What the market do? Comes down, moves up, and sweeps all of this liquidity. Tries to push down, doesn't succeed with it, sweeps liquidity actually again, even higher than this wick this time, and then does the push down. And therefore this here qualifies as an extreme order block or as a high value order block. You can call it whatever you want. You just got to know that this is the type of order blocks you want to spot in the markets. Another thing that is important to understand is that when you have an order block like this here and price comes in and mitigates this order block, according to our rule, this order block is done, has done its job. Price might come back, respect it. Maybe all the orders in this block here are not done, but you don't know. And you have seen the market enter one time. That's enough. If it enters very shallow and rejects, then it's a high probability that it will reject this order block again. But if it comes deep, more than 50% into the order block, you can consider the order block mitigated. So with that said, that's the advanced training on order blocks. To really understand this, you must participate in the live sessions, or if you can't participate in the live sessions due to work or school, then watch the recordings, because I go through these order blocks all the time. This is what we do on the charts. We chase these order blocks. We look for these order blocks. We look for imbalances. We look for liquidity zones in the market, so we know what to target and what the market is targeting, because we want to target the same thing as the market makers, right? We want to swim with the big fishes. If this is a big fish, then this is us. We want to swim with the big fishes alongside with them, all right? And pick up all the leftovers that they couldn't scoop up. So keep practicing, keep backtesting, backtest all these different order blocks, and learn to understand how they respect your market. What is your market? Your market is the currency pair of your favorite, of your choice. If you don't have one, learn to find one. So first you need to figure out your trading style. You need to understand how you trade, and you need to figure out what market best suits your trading style. Do you want a high volatile markets, or do you want markets that move slowly but predictably? Find that market, study it, backtest it, and see how market reacts to all the different liquidity zones and order blocks, so that you know what to expect next time you see an XOB or a midterm order block or breaker block and so on. And now with this lesson going to an end, you soon have all the puzzle pieces you need, and we are going to start lay the puzzle now. Basically lay out the strategy so you start understand how all these puzzle pieces work together in the market to find the best entries, the best stop losses, and the best take profits. With that said, I'll see you on the next one.